Let's stay on commodities now, because the big surprise in recent weeks is the fall in metal prices, including, very importantly for Australia, iron ore. So what's that doing to our big miners? Well, I'm joined in the studio now by fund manager Roger Montgomery. Roger, welcome back.
Thank you, Tiki.
BHP Billiton share price is now at a 3-year low. I bet nobody picked that at the start of the boom. What's going on?
Well, we talked about it here just recently. In fact, I've had the view that we don't own BHP and we haven't bought them because we believe the iron ore price is coming off.
But a 3-year low?
Yes, and Rio's trading at levels not seen since 2008, and Fortescue's down 17% since its recent highs. But the big story is the supply response, the iron ore supply response, and it's not going away. BHP has announced that its supply is going to increase by 20% next year. Fortescue Metals 25%, Rio 30% increases in iron ore. By 2015, we'll have 700 million tonnes of additional supply. That's two Pilbara regions of additional supply. Now, historically, China has taken about 60% of global production into their own steel smelters and steel mills. And the issue is that they just simply don't have the capacity to take 60% of all that additional supply.
Well, that's the flip side, isn't it? Because it's the China story. There was a very interesting article in the Financial Times today,
yes.
China investment boom unravelling, and quoting that story about Mr. Lee, the next premier, famously saying that the GDP figures were man-made, and it's better to look at electricity consumption, rail cargo volumes and disbursement of bank loans. Now, if you look at them, you know,
yes,
they
electricity is falling precipitously, electricity consumption. What everyone needs to understand is that, unlike Australia and many Western economies where a GDP figure is produced as a result of production, consumption and activity and then reported, in China it doesn't work that way. They sit around a table and they say, well, what number do we want? And we want 8% or we want 9%. All right, go out and get it. And this is how you're going to do it. You're going to build a bridge, you're going to build a city, and you're going to build a school, for example, or a road. And you can't sustain economic growth at 8% when 60% or 65% of your GDP is fixed asset expenditure. So the impact of that is lower iron ore demand combined with higher iron ore supply. And anyone who's done economics in first year university knows that the combination of those two things results in lower iron ore prices.
Do you think this is why? Because there's been a very almost deliberate strategy of both the big miners to come out with stories to the print media in particular about lowering their capital expenditures,
yes, and that's their
investments, and that's been a deliberate strategy. You look at a couple of months ago at their presentations; it was saying exactly the opposite, that they were gung ho, literally.
Well, but you don't never ask a barber whether you need a haircut, because they're always going to tell you that times are good and that you need one. But the reality is that you can't get away from this supply response. Look at every single iron ore producer in Australia and elsewhere in the world, and they've all, as a result of rising iron ore prices, there's a huge supply response, and that's the nature of commodities. They're cyclical.
So when we look at the APPIA conference running this week, which is largely about the gas story and what a spectacular story we have here in Australia, and I always thought that that shale gas in America was very much a domestic thing and they were going to have difficulty exporting. Now they're looking at exporting their gas as well. Everybody again is heading for Asia. Are we going to have the same problem?
We'll have the same problem across many commodities, and people need to remember that these are commodities and they're cyclical in nature. You get lower prices, everyone tightens up their spending, and we're seeing that's starting to happen. There's talk about that occurring now, and as a result of that smaller investment or lower investment, prices go up again, and when prices are high, everyone brings on their investment expenditure plans and supply increases and prices fall again. It's cyclical. We've had a long cycle, but it's cyclical, and we'll see lower prices again.
I think some people thought it was going to be longer. Roger Montgomery, thank you very much for joining us.
It's a pleasure, Tiki.